All right, so forecasting exchange rates, one of the very important topic in international finance. After going through this session, you should be able to explain how firms can benefit from forecasting exchange rates. You'll also learn the common techniques used in forecasting, as well as you should be able to explain how forecasting performance can be evaluated. Okay, as we know worldwide, the forecasting method used are not really very accurate, and most of the time, 70 to 80% forecasting methods are really found to be very effective and useful. Okay, um, why firm use forecasting of exchange rates? Basically, exchange rate forecast is necessary to evaluate the foreign dominated cash flows involved in international transactions, right? So when a firm get involved in international business, it get exposed to foreign currencies. Uh, Most of the time, we use the dominant foreign currencies to forecast. So forecasting exchange rate does facilitate to understand or to make decisions on hedging payable and receivable, short-term investment decisions, capital budgeting decisions, earning assessment, as well as long-term financing decisions. As you know that most of the time firms uh, do buy or sell on credit, right? Most of our sales and purchases on credit, and that's the question of hedging the payable and receivables are very important. So when we are making a decisions whether to buy or whether to sell on credit, then you may collect it back in after 3 months or 6 months, or you may pay after 3 months or after 6 months. So in that case, you need to have some hedging because we know exchange rates are very volatile. It changes over time due to many economic and political factors that we have. Okay. So there are many methods available for forecasting techniques. All right. The most important three are technical forecasting, fundamental forecasting, and market-based forecasting. Okay. Why we use forecasting techniques? Because we would like to estimate the future exchange rate in near future. Okay. Sometime we do also make a decision for long time forecasting this. Okay. When we are buying, when we are selling to certain product, especially those involved quite expensive products and machineries. In that case, we may make a decision to allow the buyers to pay in 3 or 4 years. In that case, when the foreign companies are paying you, today's exchange rate and after 3 years exchange rate, of course, is not going to be the same. So the exchange rate of your currency may depreciate or may appreciate, and that may somehow affect the cash flow of your company. You may lose a lot, you may even gain a lot, depending on the appreciation and depreciation of the currency rates. Okay. Now, this is one of the easiest method to forecast the currency exchange rate. Okay, so we say this is a technique that uses historical prices and trends. What this method does is it uses only the past price and volume. So we can look at, say, for example, as 3 years, 3 months data, and we look at 3 months prices of exchange rates of different currencies, and then we plot it in a graph. All right, and then from there we establish a pattern, and from there we'll focus what's the exchange rate going to be in 3 months' time. Okay, so predicting the exchange rate based on the historical data sometimes may not be very accurate. All right, and that's why there are few limitations of this method. Number one, it can be only used for a short term, long in near future exchange rates. So it works better when you have stable economic condition. Okay, so even though we are now in COVID, many businesses have been, got devastated effect due to COVID-19. Many are closed down. Many having a shortage of cash flows and all that. But still, if you want to forecast, still since we are during the COVID period, So if you like to forecast for 3 months, near future data, then it should not be a problem because we are still during the COVID time. So similar kind of economic situation we can predict. It may be accurate to some extent. Okay. So if you use last 3 months data and want to predict for next 3 months, or last 6 months data to predict next 3 months or 6 months, is possible. But once the COVID is managed and settled, then using this data to predict the near future exchange rate will be difficult. Even long term, of course, very difficult. So this is the main limitation of this method. Um, we cannot use it for long term. We use for short term. It rarely provide point estimates or range of future possible future values. So it just provide you some kind of ranges. Say, for example, if the Malaysian currency now, the ringgit, is 4 ringgit equals $1, then if you use this technique, it may provide you a range. Say, for example, in 3 months' time, um, in 3 months' time is going to be, say, for example, $1 equals 3.9 or 3.8. So if Malaysian ringgit appreciates, so it gives you a range, for example, like 3.8 to 3.91, see 3.85 to 3.95. Sometimes the ranges is given, not exact exchange rate is given. But as we understand for international business, as we deal of millions of dollars of business, even 0.001 will become few 100,000, or few thousand easily. So that's how important it is looking at the accuracy of forecast, because a decision that you made will have impact in the future. This model also work well in one period, may not work well in another, meaning that if you are using for last 3 months data predicting for next 3 months, maybe it may work very well. But if you use last 3 months data to predict, say for example in 2020, it may not work definitely. Okay. So if similar kind of economy, say for example, if the economy is very stable, and in that case, if you use that data, possibly you may forecast the future and expecting the economy going to be stable. Okay, so that one we have to really understand it very well. Okay, so technical forecasting, to summarize it, we use the recent past data, right? Past data, past price and volume data, and then we focus for near future, short-term forecasting. Okay, short-term forecasting. The next one is, of course, the fundamental forecasting, the most popular one. It's a bit tedious because it takes into account of many factors. For technical forecasting, we use only the past price and volume. But here we use most of the economic and political data, okay, to forecast the future. So we are using the elementary data such as GDP, inflation rate, productivity, balance of trade, unemployment rate, and many other factors we take into account to use the forecasting of this method. Okay. Someone is requesting for annotating. I think I can allow that. I'm sorry, because it will affect the flow of lecture. I'm sorry. All right. So fundamental analysis is, as it is known as fundamental. So use all the fundamental factors and issues we take into account, and then we use it to forecast the exchange rate. So this one can be used for long term. Technical forecasting can be used only for short term, but this one even can be used for long term. Okay. So it is based on fundamental relationship between economic variables and exchange rates. So you are looking at different economic variable. Okay. And here we do not just establish uh, a trend or pattern looking at the past price and volume. Rather, here we use some kind of sensitivity analysis, okay? Looking at what happens if GDP goes up, and whether it affects the exchange rate. What happens if the inflation rate goes down? Excuse me. What happens if the balance of trade is better? having a surplus in the balance of trade, or unemployment rate has lowered down. So that definitely will have impact on your exchange rates. Okay, so we use sensitivity analysis and we plot it and see what happens. This factor changes, what will happen to exchange rate. This factor changes, what happens to the exchange rate. That's what we do. So this is more practical, more comprehensive, more holistic. Okay, to forecast the exchange rate in the future. So if you use this method, it's possible for you to forecast for short term as well as for long term. Okay, so in that way, this is much better. But on the other hand, you have to keep in mind, since you are using so many different factors, the data has to be available with you, and it is bit tedious, bit complex for you to use, since it involves many factors in forecasting the exchange rates. Okay. In technical analysis, we only need the past price and volume on traded. So you're looking at the price of exchange rates, and then we are just forecasting, based on that. But here it's not that. You have so many different kind of data, and then you have to plot them, and you have to forecast the exchange rates. And we do also use people purchasing power, PPP, people purchasing power. For fundamental analysis, we are forecasting inflation rate differentials. So you're looking at the changes of purchasing power, the volatility of purchasing power people. I think in Malaysia now we do see the debates on the increase of the consumer, the prices that we use, commonly used goods. Um, I think the Gardenia wanted to increase the price of the bread, and even that has affected, right? Even the minister has to make a statement on it. So the debate is there on looking at the price of products when it goes up or down. So people purchasing power parity, or people purchasing power parity is very important when people do not have enough, to spend, and then the price goes up, then it creates problem. So you look at the volatility of people purchasing power. We look at the people purchasing power parity and see whether it can be plotted, and based on that we can forecast the inflation rate, and thus the exchange rates in the future. Okay, so this is more comprehensive, though a bit complex, but it gives you more accurate results, as we understand that almost 70 to 80% forecasting is wrong. That's But still we do forecasting because we have to have something in front of us, right? So it may not be totally accurate, but it will be near to accurate. Okay, so that's what we'll do. Okay. Okay. So what are some limitations? Uh, Limitations of fundamental forecasting include unknown timing of the impact of some factors. For example, political factors. Politically, if it is stable now, you won't know whether it's going to be stable in 2 years or 3 years' time. But most of the countries, it's like that, right? Some economic factors like inflation rate, people purchasing power, parity, GDP also can be affected by natural calamities and all that. So it's difficult in case, if you're forecasting for a long time, and certain factors you took in the model, and that changes over time. Forecast of some factors may be difficult to obtain. Some data, as I said earlier, um, because you are taking into account of so many economic and political factors in the model, certain data may not be available for you. And some factors even cannot be easily quantified. For example, like unemployment rate, to really get exact quantified data could be difficult. Same goes to political factors. Certain data to make it quantifiable or quantified could be very difficult. Okay, so when we get all these factors in, what we do is we plot it in the regression model, and we try to forecast. We see whether this one goes up, what happens to the exchange rate. So here, exchange rate become, those of you understand it, become dependent variable. The rest of them will be dependent variable, right? We put them in the modeling, and we run it and see if this factor increases, what happens to the exchange rate. If the other factor decreases, what happens to the exchange rate. So that's how we do it. Okay. So even though it is arguable that this is one of the better forecasting method that should be used or can be used. And it's most popularly used by multinationals, but still it does have a limitation. Okay, it does have limitation because of so many factors we take in, and many factors are difficult to be quantified. The third method is known as market-based forecasting. Market-based forecasting. So basically, we say that this podcast should reflect an expectation of market on future rates. Okay, so what we do basically here, we look at the current spot rate and we forecast the future spot rate. So we say if the market's expectation differ from existing rates, then the market participants should react by taking position in various currencies until the current rate do reflect an expectation to the future. Okay, so what we do is we look at the current uh, spot rate of currencies, and based on that, we try to forecast the future rate. Okay, or even we use the forward rate to forecast the future spot rate. When it comes to foreign trade, most of the trades are done in forward contract or future contracts. Okay, forward contract is a contract whereby uh, both parties sign a contract agreeing on the price and the volume and the date of exchange. Okay, so say for example, you are signing a deal today. Buyer and seller they sign a contract today. They agree on the volume. Say for example, 100 ton. They agree on the price. 1 ton is say for example 5,000 US dollar, and they agree on the date. The transaction of goods will take place after 1 year. So that is forward contract. Okay, that is forward contract. You are signing a contract today, and based on today's price, but the transaction takes place in the future. So you can use that, forward rate, and you can forecast the future spot rate. Okay, so this formula here, I'm not going to go into the calculation, but the basic understanding is you can use the forward rate that is agreed between buyer and seller in many transactions, and you can use that to forecast the future spot rate. Okay. Now, since every forecasting method has certain limitations, it is advisable that we do not depend on only one method. Okay, so it is recommended that we mix the forecasting methods. So we can employ technical and fundamental analysis together. So we because if you want to run the technical analysis, you just need only the price and volume. With that, you get a pattern and you forecast the exchange rate for the short term, right? And then you use the fundamental forecasting method, whereby you take into account of many economic and political variables and factors data. As we know that certain data are not obtainable for some reason, right? And difficult to quantify. So in that case, whatever data you get, you forecast the future exchange rate. So if you mix these two together, then you will see some kind of check and balance, and you should be able to arrive at a better forecasting of exchange rates. Okay, so you are using combination of forecasting techniques, right? So um, it is basically at a weighted average of various forecasts being developed. So we use an average of these. Okay, so even you can combine three for certain cases. If your transaction involve huge amount of money, you may employ even all three: technical analysis, fundamental analysis, as well as market-based forecasting. You can use all three, and then you come out with a better, future exchange rate prediction that may help you to at least, lessen the risks of failing to get the exact currency rate in the future. Okay, so the recommendation is using either you combine with two or you can even use all three. Okay. In case if your transaction is a small amount, then technical analysis could be okay if it's short term. If your volume is quite high and it's for long term, then fundamental is quite applicable. But yet, it is advisable that we employ we embed, we combine two or three methods together, okay, to arrive at accuracy, so that we don't lose a lot of money by getting into that. Okay. Now, again, the kind of method that we are going to use also depends on what kind of market we are in. Market efficiency means what? Market efficiency means basically whatever information we have, and it goes to the market should immediately reflect to those informations. So the exchange rate will change immediately after certain news goes to the market. Say, for example, now every country now is afraid of Omicron, like the latest COVID variant that we see now. Many countries being barred. I think Malaysia have already barred 12 countries, and there could be few more countries to be added in the list. Uh, so when that information goes to the market, definitely exchange rate will be affected. Okay, it may appreciate or depreciate depending on many other factors also. So market efficiency is very important. If a stock market of a country, the country economic, the things that you see, the stock exchange market is weak form efficient. Weak form is basically we use technical analysis. Okay, weak form efficiency meaning if you can use the past price and volume and you can predict the future. Okay, so that's where the weak form efficiency is. You can use the past data and volume alone, and with that you can forecast the future. So that's the kind of market we call it weak form efficient market. So in that kind of market, if we have in a country, then technical analysis is all right. All right. Huh? Now, semi-strong form efficiency is when all relevant public informations are reflected. Okay, so you have the information on the past price and volume, and also all other publicly available information. So inflation rate, GDP rate, unemployment rate, interest rate, all sort of informations are available readily. And if you use all this data and can predict the forecast rate in the future, that's the kind of semi-strong form efficient market you have. So in that case, we will use fundamental analysis, right? If a country is having semi-strong form efficient market, then we will use fundamental analysis, because here you have to use all information available. Okay, if a country's market is weak form efficient market, then we can employ technical analysis, because using the past price and volume, we can predict the future prices. Okay, and strong form efficient market is where you have all publicly available information like historical data, past price and volume, and all other publicly available information like inflation rate, interest rate, GDP, unemployment rate, and all kind of data available. And also some privately available information. There are certain data are private, not for public. Even if you get hold of those data, with that, if you can predict, uh, be able to predict the exchange rate in the future. So to reach in that level, that's where you have to have mixed method. If your current country market is strong form efficient market, whereby you need all kind of information, including private, to forecast the future rate, then you should be combining, say, for example, technical, market-based, and fundamental, or possibly fundamental and market-based forecasting methods. Okay, so which method of the forecasting should be used? Either technical analysis or forecasting or market-based, or you should employ the mixed method approach. It depends on what kind of efficient market you have in your country. Okay. Now, the volatility, as we know, exchange rate is very volatile. It changes. Even morning is one rate, afternoon is one rate, evening you see another rate. So morning you see there is a rate available there, and afternoon there is an announcement made by the Prime Minister or other ministers, and immediately you will see it will have an impact on the exchange rates. Or not only your country, even if some kind of drastic decisions were made by other country, whereby you get involved in international trade, China or US, Singapore, where Malaysia is strongly related in terms of international business, any decision made by those countries will immediately affect even your exchange rates. Okay, so to avoid that, to reduce the volatility, there are three common methods also we use. Okay, number one, we look at purchasing power parity, right? We look at prices of goods at different countries, and then we see whether uh, that helps. That helps. Number two, we look at the relative economic strength growth approach, where we compare levels of economic growth across the countries. So if you are having your transactions with China, a lot, right? Malaysia does a lot of export import with China, Singapore, Indonesia, US, those countries. So you'll be looking at the relative economic strength of these countries. If you see your country economy is getting stronger than them, or your country, the growth level is higher, GDP growth is higher than other countries, or GDP growth is expected to be higher in near future compared to the other countries where we deal with, that may help you. That may help you if you have that kind of data to reduce the volatility. In the exchange rate that is you are predicting. And you can use some econometrics modeling. That's where it's like fundamental analysis. You use many variables, economic variable possible, okay, to understand better the currency markets. So these three methods are commonly used to arrive at an exchange rate that is stable. Okay, so it helps you to reduce the volatility level of exchange rates. Okay. Um that's basically on this topic, right? I try to cover quite extensive, quite extensive coverage within few slides. I prepared very compressed slides on this topic, forecasting exchange rates. So I started with the definition of it, importance of it, some limitation of exchange rates and methods. Okay,